We're going to be executing off of the CWAP using the VWAP as our initial risk. So we're going to build an algo based on the VWAP. Okay, so I'm just going to open this up and we'll talk through it. I've named this VWAP 2% because I'm going to put 2% of my account at risk. Whatever my account size is, I want to have some percentage that I'm willing to risk, and you can do the math fairly quickly. If you were to get stopped out on every single trade that you took and you risked 2% of your account, it would take 50 trades to completely wipe out your account. If you risked 1%, it would take 100 trades of losing every single one in a row to completely wipe out your account. So if you were to risk 5%, it's 20 trades, 10%, 10 trades. You get it. Okay? This is how we not only positively compound our account, but this is how we avoid negatively compounding our accounts. Okay? Because if I take 5 stop outs, but I'm always risking 2% of my account, I'm going to be risking a smaller and smaller and smaller amount each time I take a stop out. If I'm always trading a 3-lot trade, I'm always risking the same amount of money. And if my account is declining because of stop outs, I'm risking a higher and higher and higher percent of my account. That is a very novice retail trader way to approach the market and almost ensures that you will blow up your account and get wiped out. So we're going to allocate some percentage of our account to trade every single trade. And in this case, I've chosen 2% as it's a good starting guideline for most people. That may mean that if you have a very small account, that you're unable to ever put on a trade. So it should give you some perspective of how much money you need to have in your account to even be a trader. If you would like for the algo to use your commission rate to size your trade, you can certainly enter that here. If you do that, I suggest that you create a separate algo for every instrument, as many of your instruments will have a different commission rate. So for example, the ES has a smaller commission for me than crude oil does. So I would need to create 2 different algos to trade both of them. Or I could just use the larger commission amount for all of my contracts. So if I wanted to put in my crude commission here, which would be the highest one that I have, I could enter that here, and then at least I would be accounting for my commission in my overall sizing of my position. We then need to choose what we're going to size off of, and that means where our initial stop is going to go. This is going to be a trade off of the VWAP using the CWAP as an entry. Notice I'm talking about the stop first because that's the most important piece. So off of the VWAP, I'm going to be entering from the CWAP. So I want to use the VWAP and I want to get 1 tick behind that. So we use a -1 to tell us that it needs to go behind whatever the value is. It's not negative meaning 1 price level lower. This is negative meaning always behind it. So that if I put on a short trade, it's going to add a tick to the stop. If I put on a long trade, it's going to remove a tick from the stop. So -1 always means behind. I can also enter minimum and maximum size positions. This is very good if you want to make sure that you never execute a trade that is only a 1-lot trade. You could say I have to trade at least 2, and if I can't afford to do it, it's going to send me a little pop-up that says you can't afford the trade that you're putting on. If I want to make sure that I never put on a trade that has less than a 2-tick stop, if for some reason the values change very quickly, I'm not paying attention, and the trade gets updated and there's something like the stop, the VWAP and the CWAP are the exact same price, or maybe just a 1-tick spread, it's not going to send the trade because the values are too close together. So we're generally not going to get into trades that have a 1-tick stop. The likelihood of getting stopped out is just too high. The same goes for a maximum stop. If I want to put in a maximum stop, that I want to make sure that I never put on a trade that has a larger stop than what I've dictated. So for example, in crude oil, the market tends to move in 20-tick bursts. So I know that if I put on a trade with a stop that's larger than about 10 ticks, I'm probably not going to get my initial 2-to-1 target very easily because the market has to go so much further. So I might put in a maximum stop of 10 ticks, meaning I don't want to take any trades that are bigger than that, even if I can afford it. This trade that we were just looking at has a 16 or 17 tick stop. If I had a maximum stop of, say, 12, it would reject the order and tell me why. I can also set up auto cancels and other features. If you want to look more in depth at this, please review the tutorial video for OFA and Motive Wave. The next step is our take profit algo. I've built a very standard, simple one that I think everyone can at least use as a starting point. There's a couple of different ways you could change this, but it's very easy. You're just going to add steps. And what it's going to do is take a percentage of whatever you've executed. Because again, we're not trading a fixed 2-lot or 3-lot or 1-lot trade. We're saying put us into a trade with this much money. So on a small stop, it could be 10 contracts. On a large stop, it could be 2 contracts. So we don't know when we get into that trade how many contracts are going to be executed. So we can't set up a strategy that says take 2 off here and 3 off here and 1 off here. So we're going to use a percentage of whatever it has been executed. So the first step on this one, I'm taking off 25% of my position at the 2-to-1 take profit. So that means 2 times whatever my initial risk was. If my initial risk was 6 ticks when the trade was filled, my first target is going to go out at 12 ticks, and that's going to take off 25% of my position. I'm then taking more profit at 3-to-1 and more at 4-to-1, and then at 5-to-1, I'm going to close the position. Now, any one of these target orders can be adjusted. So if you have a target that you want to shoot for example, we looked at this trade as potentially having a target here. If we wanted to take profit there and say our 5-to-1 target came out here, we could grab it, move it up, and put it where we want it to be. So take profit is just getting the initial orders out there so that you know that you are at least shooting to make multiples on what you're risking. It's impossible to compound your account and be an effective trader if you're not making more on each trade than what you're risking against it. The math is fairly simple. If you were to make 2-to-1 on all of your trades, you would only have to be right about 33% of the time. So imagine that. You don't even have to be a good trader. You don't even have to do, it's better than a coin toss. You don't even have to be right 50% of the time, and you can be a profitable, strong trader as long as you're making 2-to-1 on what you're risking. So my suggestion is that you start to play with what size you're going to be trading, and you figure out the number of targets that it's likely that you can have. In this case, I've drawn out 4 targets, and if I don't have enough contracts to fill 4 different targets, it's just going to send them to the next lowest one. So for example, if I put on a trade and only 4 contracts went out, I would take off 1 here. There'd be 3 left. 50% of that, you can't split 3 contracts, so it's only going to take off 1. Then there's going to be 2 contracts left. I would take off 1 here and have 1 left. So even a 4-contract trade in this scenario would make sense. If I was taking 50% here, it would cut it in half, and I would only have 3 targets. It would go 4-to-2, 2-to-1, and then the final one would come off here. The last piece is the management. Whenever we're in a trend-based trade, we're going to be using the volume-weighted average price for our trailing stop. Most of the trades that we take, at some point we will use the VWAP as our trailing stop. And the reason for that is very simple. Even if we're not in a trend yet, we're hoping that we've gotten into a trade that will turn into a trend. So my suggestion is that you start with a very basic management that doesn't have too many steps or stop moves in it, and learn how the market moves and the different levels that you might be able to move a stop to. Then you can create more complex algos. So in this case, it's very simple. I'm just saying that at a 2-to-1 risk to reward, I want to make sure that my stop is behind the VWAP by 1 tick. Now, my stop is already on this trade going to be behind the VWAP. But let's say, for example, in another trade style, I'm using the value area as my initial risk. But after the market starts moving in my favor, I then want to move my stop to the VWAP. So I just set up a very basic management algo that I can use for almost every trade, where no matter what, at 2-to-1 return, I'm going to jump the stop to the VWAP. In other styles of trading, we'll talk about different management algos that you might want to implement. Once we've got all that pieced together, we're ready to learn how to take our first trade. So now we'll move into trade example videos. You'll be able to follow along. I encourage you to think about the process involved in determining that there is a trend to take a trend-based trade off of. If you're not doing that, it will result in something where you're constantly feeling like every single move in the market is a trend, and you'll find a lot of stop outs trying to trade the VWAP and CWAP off of small moves that are not indicative of a trend. Hope you enjoy the example trades. I think you'll find that the OFA tool set is designed perfectly for following the trend.